Hi, my name is Mercedis Harris, and I am doing my project on the forecasting for the week of October 28th through November 1st, 2013. Over the course of the week, beginning October 28th through November 1st, 2013, the entire yield curve rose. Since the yield curve normally shows a relationship between the short and long-term interest rates of fixed income securities, its rise over the stated period was an indication that the long-term security rates rose beyond the shorter security rates because of the low maturity risk. Normally, an increase in the yield curves means a raise forecasted one-year rates based on the expected hypothesis. In this case, the interest rates forecast seem to have been boosted by the slight rise in mortgage rates after a fall that was experienced last week. As pointed out by Mangaroo, the fixed mortgage rates have moderated slightly over the short term as uncertainty continues over the American debt ceiling. This has continued to drive investors to a safe investment. It has also prompted lenders to lower their fixed mortgage rate offerings. The slight rise in the rate saw the average rate for 30-year fixed mortgage rate rise from 3.60% last week to 3.61% this week, as the average on the 20-year fixed loan rose to 2.5% from 2.53%. Similarly, an increase in the yield curve on Monday to 2.1% was an indication that the prices of bonds decreased throughout the year. On Tuesday, October 29, 2013, most lenders' sheets were essentially unchanged compared to the day before, as the curve rose slightly higher from Monday to Tuesday. When compared to the previous year's spending, it showed that there was an increase of 0.52% in the index of inflation, tied to spending patterns. In addition, Tuesday was not marked with market tanking, even as the partial government shutdown led to market speculation that the Federal Reserve will not alter its bond purchases this year by adding to the weak employment expectations. Despite all these, the stock still ended higher on Tuesday at 2.3%. This rise was due to the fact that the equity returns had started to outperform fixed income returns by signaling a positive equities value. The market is expected to steadily pick up. As expected, the yield curve rose from Tuesday to Wednesday by a marginal percentage. While the lowest point of the day was at 0.05%, it picked up to finish off the day at 2.4% on a one-year rate based on length of maturity. This was attributed to by investment opportunities that were aimed on countering shareholders' high rate of borrowing. For instance, there was the removal of verbiage by the Federal Reserve. It reduced risk associated with tight financial conditions. It was in the same day that Gilead, a leading global financial market and provider of advice towards expanding businesses. It was meant to help various stakeholders by giving them insightful understanding of such areas as taxation, business incentives, regulatory environment, and human location strategy. While the total bond size was not determined for this particular day, it was expected to have no big loss by the end of this week. There was a very little and slight increase from Wednesday to Thursday. A projection that is expected to rise at the end of the week. The yield curve finished at 2.4% and maturities cut rose from the starting rate of a negative 0.5%. At the same time, the U.S. stocks closed higher by a small margin. There was a flurry up and down corporate earnings that routed the market during the day. This was attributed to the fact that trading had been choppy as investors took advice from the economic data and company-specific news. On Thursday, mortgage rates remained higher like on Wednesday. Thursday recorded stronger than expected economic data. For instance, the rise in stock prices throughout this week, especially from negative 0.5% starting rate to 2.4%, made investors and scholars to look for ways of how to understand the market trends using security prices. In addition, from the steepness of the curve that slashed out as Friday, closed down was an indication that more money were being sent into safer, less unpredictable unpredictable investment. The closer of interest rates at 2.49% on Friday was an indication that the investors adjusted to expectations the Federal Reserve would inch its way out of its easy money policies. In this regard, the overall increase in the yield curve throughout this week indicated that as time steepens, fear and rush for safety actually dominate the markets. There's the possibility that rates will continue to rise as technical trend matures.